Well, we're back with you to take a look at our ag commodity markets. I'm Marlin Bohling, your tour guide here, and let's take a look at this corn market first. It opened up a little higher, then it drifted lower, and now it's trying to claw its way back again. Last time we checked, I believe we were down like a penny and a half. So July is now unchanged. We're at 7.78 3/4, and December now up a half cent. It's trading at 7.32 1/2. Let's go to take a look at our soybean trade. These quotes are provided by Bar Chart. A little pressure on the nearby contracts. You have July down 15.5 cents now at 16.89 3/4, and November down 5 3/4. Check that now 5 1/4 lower and 15.16 1/2. So boy, they are changing that spread by about 10 cents worth here this morning. Now let's move on to the wheat in Chicago, and here you currently have July 17 higher. Now we're at 11.85 3/4 per bushel, and September is up 17 3/4. In the Kansas City market, you have July 17.5 higher at 12.70 1/4. So pretty consistent gains here between those two exchanges. And in Minneapolis, well, spring wheat kind of bringing up the rear. We are higher, but July only up 6 cents right now. We're at 12.85 per bushel. And wanted to check on the cotton market too. We have July currently 122 points higher at 143.49. December up 42 points as we get things rolling here today. Well, we are joined by Mr. Chris Swift of Swift Trading. He's based in Nashville here, and he comes into the studio for us each Monday to talk about the markets. Corn doesn't know what it wants to do today.
Not yet. Probably not until 3 o'clock this afternoon.
It's very confused. Now, why do you say 3 o'clock? I know why, but
we
why?
get the crop progress report this afternoon, and I think everybody's anxious to see what kind of planting got done last week. And we're under the impression that they were able to run wide open and could be as much as 79 to 80% planted in the corn.
Really?
Yeah.
You think it'll be that high?
Yeah, I think they got with it. So
okay.
Once they get started, you know, the very first of it took 2 weeks to get up to 49%. So now I don't think it takes them any to get that, you know, real guts of it finished out.
What about spring wheat?
I think that they're getting a little bit of moisture there, and I know that planting is up, and they will probably have a bigger planted total acres on there, but whether they've got it all in or not, I don't know.
So last week, we appeared to have a role reversal, if you will, in the leadership between corn and soybeans. A little bit of spread unwinding maybe, or rewinding. I don't know how you look at that, but it seemed to be going back the other way.
It was, and it was very possible that that was the excuse. I couldn't find an excuse. You know, they said that the Indonesians had relinquished the palm oil ban. We know that meal had not been as big a demand because of the lower poultry and pork production here in the U.S. So it was kind of stumbling why we would have such a strong bean market, and that was given us several different excuses, and I won't use that as an excuse, but it is the only thing that we could find.
Let me check one thing before we get into a break. I want to look at the value of the U.S. dollar index right now. So let's bring that up here on the screen. Look at this, down 893 points on June futures. We're at 102.290. Is that going to offer some help?
Probably not just yet, because you're still right up at the tip top. You know, I think 103 and change was the top end of it, so you're still very elevated. But if it starts to come down a little bit more, and with the, we are assuming that the Fed is going to raise rates again in June. They pretty much told us that they're going to do that. But after such, they might not be able to do anything until they get to the September meeting.
Often that has a little more impact on the wheat than it does anything else,
yes,
right?
It could.
Okay, well, we'll pause right here, and we'll come back and we'll talk more with Chris here. We'll take a look at the livestock market when we return. We're talking with Chris Swift of Swift Trading, and let's take a look at our livestock trade here on a Monday. And this would be in the wake, of course, of Friday's cattle on feed report that came out after the market closed. And in general, everybody thought, well, it looks like a pretty bearish report. And we started out with strength in the cattle market, and now that's gone. This is very choppy here, Chris. So you have June live cattle 15 lower. Now you have August going down 32. We're at 131.22 per hundredweight, at least so far. As I say, we've been on both sides of unchanged. Feeders started out higher. Now you have the August contract still 77 higher. We're at 164.70 right now, off of our earlier high by about 80 or 85 cents or so. September now 32 higher at 167.32. So it appears most of the strength, if you ignore that May contract, is front-loaded here on the feeders. How do you interpret that as a result after that report came out?
Well, I think what we saw with the placements heavier in March and April, then we've already seen what the sales receipts were for May, at least the first 3 weeks, and they've all been lower. So even though we had elevated placements in March and April, it is anticipated that from May probably into August, we'll have lower placements going in. So everybody wants to own the feeder cattle market because it's about the only hedge that there is to get into the industry part of it if we do expand. The first thing we're going to have is a lot of heifers coming off there, and so they'll use that feeder board as somewhat of a hedge to hedge against incoming heifers.
That chart on the August feeder cattle, I mean, that looks kind of dire when you look at how far it has fallen, and pretty consistently since late February there. On the charts I was looking at over the weekend, it just seemed heavily oversold. I mean, is that a reason to bounce?
No, not necessarily, because we're still $10 from the index. The index is 153, and we know that the futures market expires to the index. And for whatever reason that either the CME or traders wanted to put that premium onto the market and kept it $25 and $30 wide for so long, it is a natural occurrence of convergence of basis that is taking place. And so unless you get some kind of movement out of the cash market, which you have not, it's been going down instead of up, the likelihood of the futures really bolstering up and then the index catching it is not as very good as it would be just widening the basis out, spending the rest of the few months converging it back.
Lean hogs firming up again. July up 72 today. Now we're back up to 109.72. Is there more room to go on the upside?
Possibly so. We know that with the multiple months that we've had or quarters of lower hogs and pigs reports, then it's probably starting to have an impact where you've got fewer hogs out there now. So I think hogs could find some kind of stability between, the index here at 190, somewhere in there.
Interesting. Well, thanks for coming in.
Always a pleasure, Mark.
Yeah, I always appreciate you coming in.
Sir.
Chris Swift of Swift Trading. He's based in Nashville, just down the street a ways. And Janet, with that, I'll turn it back to you.